Hi, we're back with an early concise highlight on Friday, October 9th, 2015. It's currently 7 a.m. U.S. Central Time, and this will be quite concise because we're only going to cover the S&P 500, which has put through some very interesting activity in the wake of the FOMC minutes we'll mention again shortly. And everything else is conforming, even with some movement, conforming to Thursday morning's global view chart pictures and technical discussion. And the question now is what the data has looked like, and it's all still weak. That much more interesting in the face of the equities rally, but on balance, it has been very interesting how especially the U.S. equities have been pushing up on what is a bad news is good news psychology again, because the news has been bad indeed. So, what does all this mean to the markets? Well, so far today, the S&P 500, having pushed up above a key resistance at 1988 to 90 yesterday, is up another 4 at 2010. And that's kind of important because you'll see where 2010 is this key Fibonacci retracement level. That's the overall retracement from the highs, the contract highs, all the way back down to the trading low, back down in the 1845 area. Now, the next thing we want to see is how this acted relative to the current upward channel. We had said yesterday that about the time the FOMC minutes were released, in the middle of the 12:30 to 1:30 hour on the hourly chart, this support was down here at approximately the 1978 area. And the market wasn't that far from it when they were released. They were weak, but the market said, guess what? Bad news is good news. If the Fed is still seeing things in a weak fashion, then we expect further accommodation. Now, the next key higher resistances are 2010 was also the trading high of the December contract on the rally back into the actual FOMC meeting before the market cracked again later that day on Thursday, September 17th. The lead contract ties up here at 2020, and that's also both 2010 to 2020 tied into the major 2015 2015 price level down break on the weekly chart. If it starts pushing much above this, there's nothing above it till the 2035 to 40 level. It came down so rapidly below it when it broke that channel support, and we'll take a look at that on the intermediate charts momentarily. The other thing that's interesting is, in spite of slippage back below the upper runaway band during the consolidation phase on the 30-minute chart, the hourly, we always consider more important, also needed the S&P to sell off later on yesterday to get back below its upper runaway band. It failed to do so, and therefore maintains the bullish bias for now as well. And that pretty much does it for the short-term view of the S&P 500.